This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing Podcast. My name is Peter Higgins and I'm here with my colleague Wheelie Dealer at Wheelie Dealer on Twitter. And this is Twin Peaks Investing Podcast number 82. And I'm going to hand you over to Wheelie because we have some sad news that we have to share with you of somebody that we loved and cared for very, very deeply. Over to you, Wheelie.
Right. Hello, everyone. I got a direct message on Twitter yesterday from Steve Holdsworth's brother. He was at Holdsworth 1963 on Twitter. And the sad news is that he's passed away a few days ago. I don't really know anything more than that at this stage. We all know he was going through some tough times and he'd had some difficult health issues for a while. Once I get some news on funerals next, I know many people would be interested. Once I get any more news, I'll let people know. And I know that the awful news is already out to quite a few people. But I know, there'll be a lot of people who listen to this podcast who knew Steve, or even people who've never contacted him directly, but read his tweets and whatever, and people who remember him from Motley Fool or the Lemon Fool or whatever it's called these days, because he was quite a celebrity on those boards. And he was 59 years old, far too young to go, and it's hit us. Steve was a very big supporter of mine of the whole wheelie dealer thing, and right from day one, when I started doing my website and appeared on Twitter and things, he was very supportive of me, and I'll always appreciate that. And I think it was fantastic what he did to help me, and he was very much somebody who helped people, with charity work, and he actually, his job was working in charity stuff and whatever. And it's sad, and we won't be seeing his messages, his tweets from the club that he used to be in and stuff. And it's tough. So anyway, it's the way things go, unfortunately. And I'm sorry to have to bring you that news.
Yeah, it's horrible. It's hit me hard, Pete, when you told me this.
Yeah, I knew.
Last night, and I'm going to be struggling to do this podcast. I know. He has impacted loads of lives with his fundraising, the charities he's worked for over the years. And he only retired X amount of years ago. And he did massive amounts of work with ShareSoc and the Mellow events, always volunteering, always supporting, always being on hand to talk and support other investors. And also behind the scenes, just supporting some of the newbies that were on Twitter, as well as what he was doing previously at the Motley Fool and all the rest of it, just supporting people that he saw that was having a bit of difficulty. He'd always, put an arm around them and just try and support them via DMs. And sometimes he even met some of them in public, at a pub somewhere. So it's generally just a lovely, lovely man. Yeah. And this is what I'm saying. I keep saying it on this podcast to the point that I know you guys and ladies are bored of it. We've got to cherish people while they're here. We've got to be kind. We've got to look out for each other. We just don't know how long we've each got. So just put some love out there. Don't be just focused on money all the time or material stuff. Think about other people and do some good for other people, please.
Totally.
And we're going to do what we can to support Steve and his family going forward if they'll allow us to. And we're going to keep, reminding you people and you listeners of Steve, because he was genuinely a fantastic individual and we're going to miss him absolutely dearly. Okay.
Yeah, couldn't agree more. I mean, he really was an excellent guy. And Peter hit on there how, Steve had only been retired, I think, about 3 years, and he was always talking to me about, when he retires and looking forward to it and all the rest of it. And it sort of brings it home to us that, once we get in a position where we think we can reasonably retire, it certainly makes sense to do so. And we just never know how long we've got. I mean, I'm nearly 58 now. Steve was 59, and it definitely makes you think about your mortality. It's sad. Anyway, I do know one thing for definite. Steve loved our podcast. He loved the banter and the discussion. So even though it's got off to a difficult start, and neither of us wanted to tell this to you, I think we're going to try and keep it upbeat if we can, and see what we can do. So I don't know if you want to move on to next, Pete.
Yeah, I just want to say, for everyone listening, just if you can just have a thought regarding Steve and just send him your best wishes, and to his family, best wishes, and just say a prayer for your own loved ones that you've got. And if you've got a chance this weekend or tonight to make a call, just a shout out to anybody that you have not been in touch with for ages, just get it done. There's no point waiting, because we don't know how long we've each got or they've got.
Exactly.
Where do you want to go for this, Pete?
Well, let's do the usual market bit to start, because that's what people. I know a lot of people are interested on our thoughts around the markets. I mean, we've been saying there's been a lot of talk on Twitter and stuff that the bottom was in a month ago, 6 weeks ago, whenever it was. Myself and yourself, Pete, we're always quite skeptical as to whether that was the bottom. I think it may be a bottom, but I think it's possible we could revisit it. And I've always said that the autumn is traditionally a difficult period for the markets. And it's interesting as we get towards the end of August now, because we're recording this on Wednesday, 24th of August, about 5:20 p.m. we've started. And the markets have sort of had a bit of a wobble. It's hard to tell if it's going to keep falling, but when it starts going wobbly just before autumn, it does get me a bit nervous, and I've put on more shorts. I mean, I've already had a short running on the FTSE 100 to hedge my portfolio. That's not the best tool to use, so I've now added a short on the DAX, and I've increased the short on the S&P 500. So I'm reasonably well hedged. I'm probably 50% hedged now, and I'm comfortable with that.
Okie dokie. The situation with the FTSE 100 we spoke about on the last one and the previous one, actually, previous podcast, and we both agreed that resistance, or the next resistance, was around 7,640. We managed to creep over last week 7,500 plus, about 520, and we've hit that buffer now, and we keep touching 7,500 without having been able to break through and hold below that, above that, should I say. And today we've closed just marginally down 16 points at 7,471. FTSE 250, 19,305. That was flat, essentially. FTSE All-share, 4,100. Again, flat, so undecisive. Interestingly enough, the FTSE AIM All-share has dipped below 900 again. Yeah. Wow. So that finished at 898.92. So that's below that. But I think what's interesting is that the FTSE 100, if we're using that as a global benchmark against the Dow, S&P, and you've just touched on the DAX there, Pete, and not the NASDAQ, is that we can't seem to get above that 7,550, and we haven't nudged that 7,600. And if what you're saying, Pete, is correct, if we don't get some news that actually pushes through that, and we go into September with more negative news, this could be the beginning of a rollover or a rollback. And if we give up 7,400, the next support is 7,200. And then again, we're creaking towards 7,000 again. And if that goes, all bets are off, because the panic will set in. I think what's interesting enough is that this week, what I think has triggered the market is the talk of inflation rates going up to 18%. The last podcast, I talked about the energy crisis, the cost of living crisis, and energy costs just going out through the roof, and that was my worry, that we're going to be impacted. Business is going to be impacted by that. Consumers are going to be impacted by that, and so on and so on and so forth. And it was this week when there was muted talk about possibly we could get inflation rates at 18%. The markets wobbled. They were at 7,500. They wobbled and they've been down below 7,500. They keep trying to go back up. But I don't think, we could see a pop above that, but it's going to be difficult. And then there's talk of interest rates going up to 4% or 5% or whatever.
Yeah.
And where's it going to end, and so on and so forth. So there's lots of different headwinds here, folks, regarding the markets. So some of you have seen some of my tweets. I've essentially been trimming, looking for opportunities, trying to buy some bits and pieces. And I'll talk about some of the things that's happened regarding my portfolio a bit later on. But my thing has been for a while now of caution.
Yeah.
Look at the markets, look for opportunities. There'll be more takeovers. There'll be more profit warnings. And these profit warnings are going to come from and left side, blindside you, because the companies that you think, well, they'll be doing all right because, and there's be something that you've not quite seen that the company has not declared, that will hit you. So just be careful. Do some research as a look as to exactly what could impact your company. We've been saying this for ages, regarding certain companies, but look at your own companies in your portfolio and be prepared to get rid of them, or be prepared to buy them even lower, and have some cash available.
It's interesting because in line with what you were saying, particularly when you mentioned the AIM index and stuff, I've noticed a real change in the last week where it's definitely gone, I hate the term, but it's gone more risk off. It's been a real flight from the higher risk, smaller companies. So FTSE 250, the FTSE small cap, FTSE AIM, they've all been hit hard. And you get things like the rush to the safe haven of the dollar, and there's a lot of that been going on. That creates even more problems for the UK and Europe, because obviously their currencies are falling. Sterling's been falling against the dollar and stuff, which makes oil and all commodities and all imports priced in dollars more expensive. So that hasn't helped. And obviously gas prices are super strong. And I mean, it's so noticeable that I'm getting days in my portfolio where my oil and gas stocks are either doing well or at least holding up, whereas a lot of my other stuff is just tumbling. We've had a lot of that recently, and it just feels like a risk-off mood. You mentioned inflation being some absolutely bonkers. I mean, 18%. I mean, I think back to the 70s and stuff, and I don't even remember 18% then. Maybe it was, but I don't remember those kind of numbers. I remember sort of like maybe 10, 11, 12%, maybe in the sort of late 70s, early 80s, but I don't remember 18. These are bonkers numbers. And the other thing that came up recently was the Bank of England came out with forecasts, and it was forecasting basically 3 years of no growth or very little growth, and even recession, but I just want to point out there's a weird thing in the way that the Bank of England does forecasting. There's two quirks. The first quirk is they don't factor in any stimulative policies that Liz Truss has if and when she becomes Prime Minister. And that's basically, any kind of giveaways, even if it's giving handouts to people to help with their energy bills, or it's, various cuts, that isn't factored into the forecast. So that maybe makes the forecast slightly gloomier than they need to be. The other thing that's even more interesting, and this I might have to explain this well, when the Bank of England does its forecast, it factors in a price of energy, so oil and gas. But what it does is it assumes that the rate of, the level of the price, it doesn't look at the futures curve to see how the price might be falling away. And apparently, if you look at the futures contracts for oil and gas, they are actually falling away over time. What it does is it takes it at the sort of level today and then projects forward 6 months at staying at the same level. So that bakes in a slightly more negative GDP than you'd actually have. So there's some funny little quirks in how these things are calculated. But however you cut it, the picture's pretty sort of gloomy on the macro side of things.
Yeah, I think, you know, we've had a few commentators on Twitter, and also in the public arena in certain papers saying, you know, the bottom is in, and there's time to be getting back into the market and to buying things. And I think there is opportunities out there. Clearly, we've seen another takeover today, which I'll talk about a bit later on. I think there are opportunities out there. I think there are some significantly undervalued companies, but without a takeover and with the inflationary environment, interest rates going up, the cost of employees and energy, almost every single headwinds that there could be being out there, I think there's a possibility that some of those undervalued companies could equally become further undervalued. So it's about choosing them very, very carefully. And if you've got a stock that is your number one, number two, number three holding, and it's a large weighting, as in that's the reason why they're number one and number two holding, percentage-wise in your portfolio, have a really, really good look at them. Because if any one of those three stocks is impacted and is impaled by a profit warning of 10% plus, heaven forbid, 30% plus, then it's going to really impact your portfolio. Nobody wants to end the year down 20, 25, 30%. But I've received X amount of DMs asking for support and help over the past couple of weeks. I'm trying to help people. And there's a lot of portfolios out there. There's lots of portfolios out there at the moment that are down 25, 30%. Some people are not on Twitter. They're watching stuff, what's going on, but they're down significantly. And it's not because they've chosen bad stocks. It's not because they've got into stocks that they've copied people and don't know what they're talking about. It's because simply the stocks that they bought, the management haven't let on that things are bad. The share price has drifted. And then suddenly, out of nowhere, 3 months after some positive news, they've come out and said, here's a really rubbish news now. We haven't been telling you the truth. And here we are now. We might need to come back for some more money, actually, because we've got to keep the lights on, and so on and so on and so forth. There's a lot of companies out there that haven't been completely candid with how bad things are. And my fear is that there's going to be more companies shocking shareholders. And this is not about AIM stocks, Pete. We're talking FTSE 350. We're talking FTSE All-share. We're talking 100 million market cap.
All over, yeah.
Plus companies that are just struggling.
Absolutely. I mean, I think it's worth adding as well that, you know, even though I think as a common thread, oil and gas and resources stocks, not all resources stocks, you know, even the big ones, some of them has not done as well. It depends on their exposure. I've been lucky because I hold Glencore, and because of that's exposure to coal, that has given it an enormous boost because of the energy aspect of it. So that one's done really well, whereas ones like, I think, Billiton and Rio haven't done as well. But my point is, even on these things that have done well, you can still get hit by warnings. So if you've done really well on them and they're growing to a big chunk of your portfolio, I think you still need to keep discipline, and you can't just assume they're going to keep on going up forever. And I think you still need to think, right, okay, maybe I should take a little bit off the table, stay in the stock, but just chop a bit off maybe, or whatever you need to do, you know. That's
exactly what I've been doing on a few stocks. Now, for a bit of positive news, or some people not see this positive news because it's essentially going to be another one of our UK listed stocks that's going to be taken over, and what will happen to the company after that, I don't know. But just this afternoon, another stock has been approached, and that stock is Aveva, and it's the essentially the industrial company, not the Aveva with an I, Aveva with an E in the middle, and the ticker symbol is AVV, so it's not the insurance company. And the French industrial conglomerate Schneider, which is listed on the CAC, is that the right word? The French exchange. Ticker symbol SCHN. Already owned, I think, 59% of the company, and is looking now to buy up the rest of the British company. The shares were, when I last looked, were up about 32%. So it looks like that potentially could go ahead. Basically, they've got a go ahead regarding the bid until 21st of September. Some decisions are going to be made regarding the proposal. So there's no guarantees, but that just shows the value that's out there. Another 32% pop today of a stock that was just sleeping, that no one wanted. And it looks like the market cap at the moment is around $10 billion, £8 billion, £8.6 billion. And they're looking to buy the majority of the company that, the minority of the company that they don't hold. So this is apparently the third attempt since 2015 of them trying to buy this company. So just goes to show, have a look at what's out there, regarding it.
It's interesting because first thing I noticed, looking at the chart, that jump today gets you nowhere back to where you were. Let me just check. I think it's even like maybe a year ago. Hang on, bear with. Yeah, even a year ago. I mean, a year ago it was up over 44000. Yeah. Well, it actually hit 4242, and today it's only 2781. So I would wonder if a lot of people are going to say, well, that's not enough, and so who knows?
It's what we call, I coined this phrase ages ago, Pete. It's opportunistic, but the phrase is a take under.
Yeah,
not absolutely. A takeover, a take under.
Yeah.
What should happen here, even though they're trying to buy the 41% they don't already own, is that the Aveva CEO, CFO, and other shareholders that are in there, I'm sure there's more, I've not looked at it enough, should decline, should refuse to say no.
Yeah.
I mean, come back when you want to pay us, nearer to £40 a share.
Yeah.
But the fact is, they've already got 59% of the company, so there's not much to fight. So how much power does it have? Will it be one of them that has to go through the securities and all the rest of it regarding the government saying we don't want the French to buy this? I don't know. Competition, I don't know. But it's out there. There's values out there. Just be careful of what the companies are doing out there and try and find the better ones.
It raises another interesting point, and we see this so often. When you've got another company or another institution that's got a really big chunk of a company, don't be surprised when a takeover bid comes from them. So often it happens, doesn't it? I know sometimes for me, it's actually put me off sometimes. I see a company's got a massive stake in a thing, and I sort of think, are they just there as a poison pill to stop anyone else buying it? Is it going to mean shenanigans in the future? But quite often it does work out that a takeover bid happens. So,
the important point there, and this is part of my research, so this is a bit of a nugget for you, ladies and gents that are listening. I'm quite crafty when it comes to takeovers, and I'll tell you about my 50th one in 8 years in a minute. If you've got a large stakeholder in a shareholder behemoth company in one of your companies, have a look back, go back historically, go back at 2021, 2022. Have a look at when they became the shareholder. Have a look at when they went over 3%, 5%, 10%, 15%. And have a look at those points across the chart at the price. And have a look at the price point, right? So you've got £2.50, £5, £7.50. The share price is now rolled over to £3. And they're still a shareholder. They're not sold any shares, right? I'm hitting all of those price points and I'm averaging them out, and I'm looking at the price and thinking their average now is there or thereabouts £3, £3.50, or maybe £4. So as a large shareholder now is sitting on multi-million pounds of stake that is underwater, right? Are they going to buy some more? And if they do buy some more, are you able to buy it less than them, right? So their average is still up here and you're buying below the largest shareholder. The company's profitable. The company's got cash. It's not burdened with debt. You're buying below the largest shareholder and you're waiting to see if they carry on being profitable. Inflation drops down. Yeah, interest rates don't go sky high. The Russia versus Ukraine war is over with. There's an opportunity for you. Things get better. mergers and acquisitions start really climbing, not just opportunistic one, you're buying at nearer the nadir of the company's share price, as a private investor, versus a large corporation with X amount of different people that are doing the research for them, right? In-house, outsourced, experts are going, this company's worth £5 a share, minimum, and even in this current environment. You, as a little minnow private investor like me and Wheelie, right, are able to buy it at £2.5, £3, £3.50. A 50% move in a 350 share, £4.75. They bid £5, happy days. All right. And this is what I've been doing for absolutely ages now. 20 odd years of trying to refine it, look at all the sum of the parts and intrinsic value. I'm always looking to get £1 of assets for less than £1. Hopefully 50p, 60p, 70p. I don't want to buy a pound's worth of assets for £1.20, £1.50. What's the point? Unless it's a tech company and it's Apple and or some sort of company, I can buy it at full price or above, knowing full well that it's profitable, it's in a racy sort of environment, niche, and the share price is going to absolutely soar at some point because the revenue is going to kick on. But other than that, when it comes to buying companies that are turnaround companies or recovery companies, I want to buy it when it's on sale. I've been buying some stuff this week and last week and the week before last, just tiny little position. I've bought a big position in 2 other companies, irrespective of what's going to happen with the markets. And I'll talk about them another time. But the opportunities are there. The opportunities are definitely there. But what really is saying about have a look on who the shareholders are is very, very important and key, because some of them are not going to do anything. They're never going to buy the company. And if they do buy it, they're going to buy it when it's even lower and lower and lower. So pick it up for absolute pennies, So be careful.
Mate, a quick interlude, I want to just mention that there's that special 25th anniversary deal going with SharePad. You've got until the 31st of August to take advantage of it. So the clock is ticking down now. We're recording this on the 24th, so this should be out for the weekend. So at the weekend, you should still have time to sign up for it if you want to take advantage of the offer. You can find out about the details of it on my homepage. That's www.wheeliedealer.weebly.com. It's all on there. Follow the instructions exactly, and that will get you the deal. It's only on SharePad, not on ShareScope. But I thought you might find that useful.
Yeah, I've had a few inquiries about it as well, Pete, and a few people have been taking up the offer. So it looks like it's a good offer. The beauty of the ShareScope platform, and I'm not being biased here, is that there's lots and lots of support, and they're quite nimble and on hand to support you regarding all sort of questions and enabling you to learn all the different tools that are available on the platform as well. So that's one of the benefits of having a small, nimble firm, or a large, nimble firm, having enough staff to support you with it. So you can learn all the different nuances of how it works as well.
Absolutely.
So Pete, tell us about your DAX short. That intrigues me, why you've used the DAX as one of the vehicles to short.
It's a funny one. Do you know what? I don't know why, but I had in my brain that the DAX had 30 constituents. That always sort of put me off a bit, because I was thinking, flipping out, that's a concentrated beastie, really. But recently, it actually changed to 40 stocks. So it's now the DAX 40. So it's slightly less concentrated. But what's really what's really interesting is that when the markets go in a risk-off mood, what I tend to find is that, because of what we've talked about before with the weird weightings of the FTSE 100. So you've got like AstraZeneca. Did you say it's now the biggest company, or it's buying with BP? It's
buying with BP. Yeah.
And it's the thing is, the index, the FTSE 100 index, is a really strange index, because what it does is it works by weighting. So companies with a big weight have got more relevance in how the index moves, whereas when you look at some other indexes, I believe the DAX is like this, and certainly the Nasdaq and Dow are, they aren't done on weighting. They're just like all equal weight. So it's an equal weighted index. Every company, however big it is, you know, how it moves affects the index. So it makes the FTSE 100 a bit of a awkward one to use for sort of hedging and stuff. So what I wanted was something that was a bit more likely to match my portfolio on the down days. And obviously it's going to match on the up days. And what I noticed with the DAX is that when you look at the performance of it compared to S&P 500, the Dow, the NASDAQ, pretty much anything else, it's been lagging. It's even behind the CAC 40, the French index. So it's been lagging. So it's been a weak index. Even though it's been going up, it hasn't been going up anything like as strongly as the others had. And I thought to myself, if I'm going to short something, it makes sense to short the weak one. And so I haven't done a big position. It's a very small position on it, but it's probably the first time I've actually shorted the DAX, or it might be the second time in my life. And
let's hope it's not your last, mate. Yeah.
Well, it might be. It might be. You know. But you know, it'd be interesting to see how it works out, and as to whether it works as a good proxy. In an ideal world, I would use the FTSE 250, but there's various limitations, like it needs more margin and you can only trade it in hours. It's just a bit of a nuisance, really.
Yeah.
You know, I just find it more convenient to use those bigger indexes, even though they're not as good in some ways.
So how much are you hedged at the moment then, overall, against your portfolio?
Well, it depends how you calculate it. I tend to give my performance figures against the starting exposure of my portfolio at the start of the year, and against that I'm about 45% exposed. 45, if you allow for the fact that my portfolio shrunk a little bit and is not as big, then then I'm probably about 50% hedged at the moment in time. So, you know, if the markets fall, I'm still going to suffer, but hopefully it will take the edge off by having some hedge there. When they rise, obviously, because of the hedging, I get a bit of a drag. So I haven't done as well in the rebound as a lot of other people have done. But of course, now that could be paying off. So, you know, it's all swings and roundabouts. But I would like to get out of the shorts. One thing I wanted to mention was that in this current situation, I'm much happier with the shorts I'm putting on now, because I feel like I've made the decisions carefully and thoughtfully and well planned, and I've sort of been health-wise feeling in a position where I could do it that way. When I put on some of the hedges before, they were a bit of a rushed panic job, because it just so happened when the markets did that big drop back in April, it was exactly the same time I had to go in for the operation. So it's just like, you know, it was just so frustrating. But of course, it doesn't help when you're feeling a bit rubbish after an operation. You're thinking, should I short or not? And you're tending to go on the side of caution because you're feeling loads of pain and not on top of the world. So, yeah. But anyway, that's where it is.
Okie dokie.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe, and you'll always be the first to get the new episodes. Thank you for your continued support.
I want to share some positive news regarding the markets, regarding one of my portfolio holdings. And it's one that's caused a little bit of trouble for myself and other people that hold the stock. And my good friend Henry Viola, that you guys and ladies will remember, that was on the podcast with me a little while back when Pete was poorly, was another one that held Darktace. There wasn't many others that held it, so you can ignore the other people that have come out since and say that they hold it, because that's what happens sometimes when takeovers happen. There's always a few glory seekers. So we're in the stock. I bought it in January of this year, so 24th of January, bought it at £3.68. 22nd of February, bought it at £3.36. I did my sum of the parts, intrinsic value analysis of the shares, and my view was this is a £6 share all day long, £6.20. It IPO'd at 250, gone up, I think, to a tenner at some point at least. I might have some of these numbers wrong, so I've not written down the stats, but It's flown out from the IPO. Then it rolled over. There was a couple of people selling inside of the time frame that should have been locked in, and all kinds of shenanigans going on. And then there was noise about Mike Lynch, who sold Autonomy, and the allegations of fraud and so on and so forth. So everything that could hit the share just kept on hitting the share, and it went from from where I bought it going up to I think the first time I disclosed it at £5 and put the contract notes out, because it was an Irish stock. I didn't want other people to be jumping on it just in case it didn't go right. Oh, anyway, so all going well, and then it rolled over. Everything's going wrong with it, and we waited, and then there's noise about the Mike Lynch stuff, as I said. However, there's a company out there, private equity company called Thoma Bravo, that's buying up, private equity company with very deep pockets, buying up every single tech company. I'm exaggerating. They're buying up a lot of companies.
They can have your mind.
Well, yeah. And basically, there's Darktace on the 15th of August. So betwixt the last podcast we've done and now, basically, Darktace noted, I was on the 15th, that speculation of receipt of a number of preliminary and conditional proposals, and it's in early stages of discussions with Thoma Bravo regarding a possible takeover. Next day, because this was after the markets weren't open, the share price jumped 24%. To £5.15. It's been umming and ahhing ever since. Obviously, I've got my SOTP, intrinsic value price, at £6.25, and I'm thinking, it's still too cheap. Then there was noise that there's possibly 1, 2, or 3 other entities that would be interested in Darktrace. This is one of the number 1 AI cybersecurity companies in the world, right? So if it's going for £6, that's still cheap, by the way. So more noise about it, saying other companies are coming to look at it. I decided, in order to lock in my 50th takeover in 8 years, to trim some at £5.35 to £5.41 to lock it in. And that was just about 15% below my own intrinsic value that I saw it as at £6 odd. If we see 1, 2, or 3 other companies coming in for this, it'll be a fight. It'd be a takeover battle. The concern I have regarding it all is that if the deal is triggered, and it's got a couple of weeks now, or maybe not so long actually, for Bravo to say, we're making an offer at this price, and it opens all the books, is that the deal could trigger a full national security review, and that takes ages. This is what led to me nipping in and getting some Avast shares when no one else was looking. If you remember, I talked about it in the last podcast. So that's one of the reasons why I trimmed it as well. So I'm doing it ahead of Thoma Bravo declaring what their price is at, and also because I'm worried that if they do make a bid, it's going to trigger a national review. Could be waiting 6 to 9 months. During that time, the share price drops. If the CMA goes, actually, we don't like to look at this because it's a lot of security implications for Darktrace. They know too many stuff of our stuff. We don't want it to get into the wrong hands. So we might be against this. The share price will tank. So I've locked it in. I'm keeping an eye on the price. I might trim it again at some point, but I'm just being cautious in this current market to just lock in as many gains as possible, especially when you lump 50 grand in a stock and somebody says to you that 2 weeks later you can have another 25 grand for it. Why not? Why not take it off the table? So have a think about it, decide what you're going to do. But whenever you get a takeover, and Peter said this to me before, right? Sometimes he takes them off and sometimes he waits. But a lot of the time, you've got to have your mindset as, what is this company worth? If you don't know what it's worth, then when the takeover comes, you don't know whether it's cheap or pricey. You're going on Twitter, you're reading everyone else's comments about it. And some of those comments could be from people that don't even own the stock. Just commentating and regurgitating stuff they've read elsewhere themselves. Yeah. So how do you learn how to value a stock? Yeah. Get yourself some good books on that particular one, right? And have a look at the book value of the company. Have a look at what the peers are going for, price per sales, price per book, and so on and so forth. That's the easiest way of doing it. Don't be using the PE ratio to work out whether its value is. Yeah. Have a look at what it's generating in revenue. Have a look at what it's generating in profit. versus its peers. Have a look at what the other companies are out there in their sector and what the market cap of those companies are versus the company that you own. And then have a look at the ones that have been taken over recently in that sector and what price per book and price per sales they've gone at. Yeah. And how closely similar they are to your company. And that will give you a benchmark as to what ratio you should be looking at and price market cap you should be looking at for the value of your company. That's a little quick cheat sheet of how to value your own company. Pete?
Yeah, that's all good stuff. Mate, if you sort of done on that topic, do you think?
Yeah, Darktace. Yeah, you go.
Right. I want to just bring up something, and this stems from, I met up with James from Twitter, yeah? So he's James1N1 on Twitter. He was over from where he normally lives in Hungary. And we met up for a beer, and this must have been last summer, right? And he said something that really got me thinking. And he said that with his portfolio, he used the words, "I'm trying to keep momentum in the portfolio." So those words, momentum in the portfolio, really chimed with me and really made me think, you know, that's not something I'm doing. And I think, I mean, I've been thinking about this a lot. I mean, this conversation was a year ago or more than a year ago. And I've been thinking a lot about it and what it means and how to keep momentum in your portfolio. And it's you know, it's going to be things like when one of your companies warns, you've got to get rid of it. You know, first profit warning, out the door. Don't waste time with it. And I think in the past I've been too generous to stocks that have warned. And the problem you get then is they go into sort of rehab and stuff, and they can take 2-3 years. I mean, quite often they just keep falling. So you've got negative momentum, which is what you don't want. So anyway, the point is it's about momentum in the portfolio. Now, because of my health issues this year, I haven't really done anything on it. But I'd like to think that, I mean, there is light at the end of the tunnel for me. And I like to think that probably not this year so much, you know, not 2022. But I think probably as we go into 2023, my attention in terms of how I invest needs to get more towards this concept of keeping momentum in the portfolio. I think in the past, I haven't needed to, because in many ways, and certainly over the last decade, it's actually been a very easy time to invest. And you didn't need to be particularly active. You didn't really need to do much. And you made loads of money without really doing anything. You know, and you've got to balance it, because my income portfolio, which only holds 14 stocks with an intention to go to 15, you know, I'm very inactive on that. And yet this year it's up, I don't know, 13, 14, 15%. It's had a really brilliant year. So you've got to get that balance, and it's all about lifestyle and how active you want to be and all the rest of it. But I think there's some simple changes I could probably make that would improve momentum in my portfolio. But where are you on this, Pete?
On the momentum side, mate, I call it having a bit of spice in my portfolio. I think the importance for me is that, as you know, I bore people with it. You know, AstraZeneca is the largest portion of my portfolio, but I like to have something.
You're joking.
I've never told anyone that.
Never told anyone. You keep that quiet, don't you?
I keep everything quiet, Pete. You know me, under a bushel. So the thing for me is you've got to have something in your portfolio, because, well, you don't have to have something in your portfolio. I speak to some people.
Well, it's not much your portfolio, you don't have anything.
I've got very, very staid portfolios, capital preservation is key and all the rest of it. That's great. You know, and you've got all the other groups of people now that are going towards index funds and ETFs. That's great too. But I like to just research, Pete, and find something that's a little bit off piste and all the rest of it. So if that's the momentum that he's talking about, I like to have something of interest in my portfolio that keeps me alert and all the rest of it.
Yeah.
You know, a typical example, you know, X amount of years ago, buying ITM hydrogen, it's been lampooned and smashed to pieces, and everyone's going, hydrogen, those idiots over there, blah, 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 blah. Now, if you type in hydrogen investment on a search on Twitter or on any search engine, there's masses and masses of investments going on regarding hydrogen now, right? X amount of years after I invested in ITM to start with. It's already 30 bagged for me, Pete, right? And now other companies are getting into that space now, belatedly. The share price of ITM has rolled over. But I keep in the portfolio because I've got a little bit of it left, just out of interest, you know, so it keeps me alert as to what's going on in the sector.
Yeah.
But you could have a really, really good company that constantly has loads of news, and that creates momentum within the stock. What happens a lot with stocks, yeah, is that the larger the company, I think, excluding AstraZeneca and GSK, is that you get a company, it's large, comes out with half year, full year, that's it. In between those times, there's no communications being made or whatever. Share price goes up on each point of news and then comes down again. Up again, down again, up again, down again. So if you've got some smaller cap companies, there's always something going on. They've got the trading updates, they've got investor presentation days. Yeah, they've got the AGM that they're going to tell you about, that they're going to be having, and putting out a bit of news on that. They're trying to win contracts all the time, you know, so you've constantly got some ebbing and flowing of momentum. And if it's constant positive momentum, regardless of the inflationary environment, recessionary environment, that small cap winning a couple of contracts, especially if they get some big ones, all of a sudden you've got X, Y, and Z talking about it. It's being tipped on the Saturday papers and the Sunday papers, and the share price is off to the races. And that's what creates a bit of momentum in your portfolio. The other aspect of it is to maintain momentum in your portfolio is when you see a stock rolling over, if it's not one of your conviction holdings in your portfolio, trim it. If it's gone up and skied off, trim some off, cut some off, a bit like Reg Hoare has said on the Investing Matters podcast, take some off the table.
Yeah.
If it rolls back down again, buy some more down there. You know, create your own momentum, reinvest it. You know,
I mean, one thing along these lines that I've already talked about on Twitter, I know I have, is at the moment I have like my WD-40, so the idea of 40 stocks. I've probably only got about 37 or 38. What I'm seriously thinking of doing is reducing that down to 30. And I think that discipline in itself, I mean, with 30 stocks, I think you've still got quite a lot of diversification. So, but you know, so you're just sort of avoiding some of the pitfalls and the risks of having too concentrated a portfolio. But equally, you've also reduced it to a size where you can get some spirit out of it, particularly if you can get into some momentum. So, you know, that's just the way my mind's thinking at the moment. I haven't really thought it through, but I will be doing more thinking along those lines. And that's really the way I want to go, probably in 2023. So that's really a big change I want to make. And the obvious one is on a first profit warning, it goes out the door. Just don't have any patience with it.
Is that what you're planning to do going forward then?
I probably will start doing that. I probably will. I need to think more.
That's a radical change for you, Pete, because I'm conscious of the conversations that we've had before.
Yeah.
You know, where, you know, not being disrespectful now, other people have probably called you this on open Twitter as well. You are Peter the Rabbit. You buy it, you hold it, and you don't do anything. It gets delisted or it gets taken over. That's usually the only time you exit. And what you've been doing so far this year, you've been trimming. You've sold a couple of things. You did fantastic on tech, Telecom Plus. You took some off the table. You've been really changing your strategy a lot, I think, this year.
Now that's interesting. I'm not sure if I particularly changed this year, but I see what you're saying.
More proactive. You're definitely proactive.
Yeah,
more proactive.
maybe that's true. Maybe that's true. I think it's just. I mean, I need to have another conversation with James and get more of a feel of what he does to get momentum in his portfolio, because I think that'll be useful. Which is one of the best things about meeting with other people is you can have some really interesting discussions and you get ideas from them, you know, and you know, And I'm not talking about stock ideas. I mean, stock ideas are sort of 10 a penny.
Strategy ideas.
Yeah, but strategy, approach, methodology ideas. That's what I find the really useful part. It's funny, we're talking about number of stocks. Let me just say to you, I actually know people who have like 3 stocks. And I just don't know how they do it. I really don't. But they're good investors and they do very well. But personally, I mean, that for me would be a step too far. You know what I mean? There's no way I could do that.
The thing is this, right? A concentrated portfolio works in a bull market, right? If your portfolio is very concentrated and you've got the right ones, good quality, small, medium, or large, whatever size, and you've got the best of the best companies out there, and you've got a concentrated portfolio. Let's say I view concentrated as sub 10, sub 12 entities, investment companies, stocks, shares, 12. That's concentrated for me. Less than that, 3, and one of those. So let's just say it's worth 33% of your portfolio.
Yeah,
and it comes out one day, blindsides you, it's down 30%, 40%, 50%. The work that you've done in 2021 and so far in 2022 and 2020 has been undone. Starting again.
So just
gone. Snatched from you. It's been snatched from you. And you're scratching your head, you're beating yourself up. Your psychology is messed with now.
Oh, yeah.
Are you going to take the same level of risk of 33% or less than 33% now because you haven't got 3% to put into the next one? You're going to put all of that money in that and double down again. You're literally going into the casino of the investment world. And you're going, wallop, there's 33%, 25% of my portfolio or money that I've got in this third company. And I'm hoping I get it right again this time. We as investors, and even the fund managers I'm speaking to on a regular basis now on the Investing Matters podcast, you've all got to go and listen to that if you haven't listened to that yet. Just spoken with Alex Schlick, who runs Yellowstone Advisory. He's a former fund manager. Most people didn't even know that he was a former fund manager, right? Spoken to him about investing as a fund manager, investing as a private investor. Fantastic interview. And he talks about how to look at a company's balance sheets and also look at the P&L and look at all these different nuances that enable you to find undervalued companies and how to get into trends and thematic investing. Fantastic interview. I recommend you all go and listen to it. The thing for me, Pete, is this. We're in a situation where we have to assess each company, right? And if you're not sure about the company or the current macro environment, this is the biggest worry for me now. Where are we at? People talking about, it's market's bottom, you don't need to worry, pile in now. And I'm going, please stop saying that, because there's some newbies out there that actually will pile in, and be buying stock. And then where are you when it's dropped 30, 40, 50%? Are you going to go and sort them out or help them out or whatever? Probably not. So a few people have said this, right? I do this in a smaller way. Phase in your investment. Okay, you want to put the 25% in your portfolio in that one company. Heaven forbid, right? Phase it in. Put 5% here and wait a little while, see how the market goes and what happens to the markets in 2 or 3 months. Whether the share price go up or not. Had another 5, see where the market goes and what the stock price does and whether the company does okay or not. Had another 5. And eventually you've got your 25 spread out over various different prices and you're there, sit back and wait to see what happens with the market. The concern I have with lumping in sometimes, and I do this sometimes to my detriment and sometimes it plays for me because I'm looking at all the different nuances. And if I can get that right, just above 50% of the time, people when I lump in, happy days. When it doesn't go right, I'm thinking, now that's the full weight I wanted of that position. This is the concern I have. I've got loads of cash sitting around. That was the full size I wanted. I didn't want to go above 2.5%.
You've got nowhere to go.
Do I now that the 3% is now 1.75% or 2%? Do I then buy it back up to go to 3%? It's now essentially was and is now an overweight position because the position has shortened and got devalued. I've always got to really think about that. How much do I trust this company? How much do I value them? And how do I see them getting back? Because it must have taken some news for it to just drop, or my timing is just terrible, and my timing is terrible on occasions as well.
It happens.
So it's all of those sort of nuances, and that's half the reason why I phase in more often than not. And it's only when I see certain catalysts coming up that I go lump. And when I lump, my lump is a big lump. I had the conversation with you, Pete, about BooHoo. And I put the tweet out and I put the contract note out, and I made purposely show people that this was just a book post stamp to just say, I'm going to keep an eye on that. 700 quid, bosh, peanuts for my portfolio. Might not be for some other people.
You're interested, that's the point.
And just wanted to keep an eye on it.
Yeah.
I added some more when the share price went up. What's happened to BooHoo since? It's got creamed. I'm sitting here watching a slow car crash, mate. It's gone sub 50. I'm going, well, there you go. What would happen to that if, I've lumped in 50k.
Oh, if you'd have gone mad on it. Yeah.
My 50k is worth 30k in the blink of an eye. I'm like, that ain't happening. I'd have been selling already, but I'm sitting here with peppercorn amount in it, waiting to see what happens.
Yeah. That makes sense. Mate, I hinted at it, but I just want to expand the idea. Part of my thinking on keeping momentum in the portfolio and perhaps being a bit more active is that I think the markets are changing. I think, as I said, we've had a very easy 10 years. Stocks just went up. You couldn't fail to make money. I think we are now moving into a period, which could be a few years, where it's going to be much more sideways in the big picture. And I think it's going to be a lot harder to make money. And I think we're going to have to work harder. I really do think that.
I've been saying it for a while, Pete. I think the difficulty we've had, and you've touched on there, I don't like to use the word easy. We've had it easier. There's still some people out there that haven't made money, Pete. There's still some fund managers out there that have not performed and just taken people's money over the last 10 years. The dogs funds and all the rest of it that are out there, and some people that have done exceptionally well. I've got people saying, well, what's your CAGR? What's your performance on this and this, that, and the other? Nothing to do with you. I retired and stopped, having to work for anybody 14 years ago. You can't do that by gambling for 700 quid. You can't do that by having $1,000.
You can if you're amazing. Yeah.
You know what I mean? It takes a substantial amount of money to be able to do that. So I'm happy with my position. I don't need to be competing with you. I don't compete with anybody but myself. Yeah. You don't need to know what someone else's CAGR is. You don't need to know what someone's year-to-date performance is. You need to know how well you're doing. And are you free enough? Do you have the financial freedom to do whatever you want when you want? I've got that freedom. I don't need to work for anybody. I've got two bosses. One's my wife and one's my 14-year-old.
That's enough.
That's all I need. You know what I mean?
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin Petes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
Pete, I want to touch on a stock that's had loads of attention. I need you to pop, just bear with me. I need you to pop the name into the ticker symbol into your phone for me, right? The ticker symbol is GGP, and the stock is Greatland Gold.
Greatland Gold, GGP, yeah.
I know lots of people that are in this stock, that have been in this stock, that have made hay in the stock, and it's been one of the AIM mining gold commodities plays that ever. So just look at the chart and just tell me where the low is from a year and a half ago. Yeah.
From
has gone from the base is tiny, spiked higher. Yeah, Pete, what have you got as a high?
Well, nearly 3 years ago, it was down at maybe about 3 pence.
Right, and the top is?
The high looks to me about, say, 37 pence, something like that.
37 pence. It's been rolling over for about 9 months to a year now, right?
Yeah.
He came up with some really good news, and I've actually been putting out. You guys can find this on my Twitter feed most mornings, or every morning. I've been doing it every morning for the past month or so. It's a new thing I've added to my timeline. Positive RNSs. I'm going to do a quick scan of the RNSs in the morning, and I'm only going to tweet about the ones that I think actually are positive. So that's a little filter to save people a lot of time. Use about 4 or 5 stocks. Here's a positive RNS regarding this stock, whether it's a FTSE one or an AIM one. And it came out with some positive news just last week. Unfortunately, belatedly today, it's come out saying it's raising money again. Right? So the share price has crashed, and lo and behold, they're back in the market again, right? Looking to raise 25 million quid at 8.25 pence, a 12% discount to the close. Yeah. The stock has halved since the placing they did in November 21, right? And they're back for more money, right? I haven't done the stats because this news has only just come out. But if you look back 4 years ago, 5 years ago, at Greatland Gold's share count, how many stocks were actually, how many shares were in the market, right? What was the share count, total number of shares available? Have a look at the total number of shares today, right? And have a think about how many shares will they need to throw at the market to raise 25 million. Dilution, dilution, dilution. Great-ish company that's done well for some people, but you're back at 8.5 pence and you're diluting and you're getting for another 25 million pounds. How much money has been taken out of this company by the people that actually own it? Yeah. And how much money has been returned to shareholders? Yeah. How much gold have they found and how much profit have they made from that? How much profit have they generated? So on and so forth. There's been lots of money raised by this company over the years. Yeah. It's a great company. I've seen it and I've looked at it and people have gone, whoa, Pete, you should be in this. And I've gone, I'm not big on mining stocks. I never do well with mining stocks. I've just managed to navigate the lithium space just about. Yeah. But just keep an eye on this one again. Back placing again. I don't like it when companies keep coming back for money.
I'm just looking at the gold price, because whenever we discuss a miner, the first thing my brain is thinking is what is the underlying commodity doing? And it's interesting, the gold price over about, I guess that's say a year and a half, maybe 2 years, really been going sideways. So it's sort of peaked at, sort of like $2,050 or whatever it was. And it's got a low of around, say, 1675, that kind of level. And we're heading back towards the bottom end. But it just seems very much sideways range, which isn't a disaster by any means. But of course, the problem gold miners have got, and all miners have got, is their extraction costs are rocketing because of the cost of oil and the energy costs for digging it out, and the problem with getting spare parts for the rock trucks, the problem that you've now got to pay your labor more. I mean, it's like anything. It's costs for businesses are rising, and it's not necessarily getting any easier to get your price for the product you sell, even if you have a product to sell, which I'm not clear GGP do. So,
absolutely. Sorry, I interrupted you earlier. You were going to say something else. Sorry, mate.
No, mate, all it was, I just thought before we cover any stocks, I would just mention the backup charity that we're
go for it.
We're backing this year. So Backup is a charity for spinally injured people. I'm spinally injured myself. I'm a T3 paraplegic in the vernacular. They do some brilliant work. They do a lot of work in sort of the rehabilitation side of people who've had a spinal injury, and it goes across all ages, but they do a lot of work with children and stuff. And they do things like outward bound courses, and they do, it started off as a skiing thing, really trying to get disabled people able to ski, because one of the first people who was involved in Backup was very much a skier himself before the accident he had, which was a skiing accident, I believe. So they do a lot of work in that space, and they also actually employ a lot of spinally injured people in the actual charity, which is a good thing. So anyway, that's the charity we're supporting this year. If you want to help us, raise money, because all charities are struggling at the moment. It's not easy. We're on justgiving.com. It's justgiving.com/fundraising/Twin Peaks. Anything you can give to help would be fantastic. We're up to a total now of £1,989. Actually, we are over the 2,000s. I've got a very good friend who I won't name and embarrass him, who doesn't do it through the Just Giving site. He just goes direct and give them the money, which is sort of cool. Anyway, so just want to mention a couple of people. I noticed we've had a lot of people have given donations, and we haven't actually had the chance to mention them all. So I'm just going to try and pick out a few. Richard S, great work. Thanks for the podcast. Give us 50 quid and the gift aid, which is brilliant. I have to press a show more button to find more. Right. Let's just scroll down a few. I'm trying to figure one. My mate Phil Sloan. I know Phil really well. Good mate.
He's a good lad, Phil.
Oh, he's a really good guy, Phil. You can find him on Twitter. I think he's just at Phil Sloan or at P Sloan, something like that. Sounds a fantastic charity. Keep up the great work, mate. Cheers, Phil. Brilliant. 30 quid there. Lovely. Vonnie. We know Vonnie, don't we?
Good old Vonnie,
Von joined us on a podcast once, so that was brilliant.
Yeah.
And she'd give 100 quid and 25 quid gift.
That's lovely. Thank you, Vonnie.
You two are fantastic. Keep up the great work. So that's brilliant. Little Lynn, I'm not sure if I read this one out before, but it's a big one with lots in it, so I'm going to read it again. And he or she has said, great charity choice. Thanks for the Twin Peaks podcast. Love recent session with Bonnie. It's Bonnie. Bonnie, Johnny.
Yeah, so that's a while back. Okay.
Yeah, easy confusion. Regarding tuition fee analogy, continuing making lots of mistakes, so continued learning lots. Nice 50 quid and 12.50 gift aid. Brilliant. Our mate Scrumpy, good old Scrumps.
Good old Scrumpy. He tends to give quite a few donations over the course of time. So thank you again, Scrumpy.
Why not? It's a good way, drip in some at regular basis. TPI 73. So we're going back. If you haven't heard podcast TPI 73, fascinating interview and topics discussed. Well done, Henry. So that's Henry Vola. Henry, Pete and Peter. Shame you couldn't make it, but hope things go well and hear from you again soon. So that's fantastic. I'll do one more. I'll just look through quickly. I'll tell you what, I must mention this one. It's a good guy, and I had to give him the sad news earlier today that we mentioned at the start of the podcast. I don't want to dwell on that, but Mark Bentley, really good guy, Marble 100, very involved in shares.
Brilliant guy.
Yeah, he gave us a donation. It doesn't say how much, so it's all very confusing, but it says, great work, Pete and Pete. When I have a spare moment, I enjoy listening to your banter on the podcast. Some great messages in there for newer investors to avoid some of the pitfalls. Thanks, Mark. That's brilliant, and I hope you're cool with the awful news. Anyway, that's basically, if you want to give to charity, it was the link I read out. Or if you go to my Wheelie Dealer 2 website, go to the Twin Peaks Investing Podcast tab, and right at the top, there's a link to that Just Giving page. Or if you're still struggling, send me a DM or whatever, and I'll send you the link.
Yeah. On every single podcast that we do, I write up all the feedback we've had for the previous one. And on the link that goes to my website, all the feedback we've had is on there. And there's 2 or 3 links that will take you directly to the Just Giving page as well. So thank you all for the feedback as well. I've had some phenomenal feedback regarding the last podcast. For some reason, you guys are liking it, with it just being me and myself and Wheelie. I'm trying to get a guest on. Should have had a guest on today, but didn't happen. And given what you told me last night, Pete, I don't think it would have been appropriate to have a guest on today anyway. I wanted to share with you guys, if I may, a bit of news regarding the charity I'm an ambassador for. It's a disabled children's charity called Menphys UK, and you, ladies and gents, kindly supported that fundraise I did and Pete did last year for the charity. I'm trying to get you, ladies and gents, to share this information if you know anybody in your vicinity or businesses that you work with that may or may not be Leicester City fans, Nottingham Forest fans, Irish football, Northern Ireland fans, because we've got Martin O'Neill, who's a former Leicester manager.
Even I've heard of him.
Well, there you
And
go.
I know
guys.
nothing about football.
Guy. So we've got him at a huge event we're holding. And it's going to be at the King Power Stadium on October the 27th of this year. And he's going to be doing a Q&A. We're going to have some surprise guests, hopefully some of the players that played with him at Leicester and a few other clubs, and also some of the current Leicester City football players. We're hoping to get them to come as well. So if you want any further information about that, contact Menphys direct, or just send me a DM, or look out for the tweets I'm putting out regarding purchasing a ticket. Obviously, it's a fundraising event, so we're trying to just keep supporting the charity and keep them afloat so they can support the young people and their families in the community. So that's just me giving you a shout out to just have a look out for that particular information. If you are interested, just get in touch with me and send me a DM, or just ask me a question on Twitter and I'll direct you to it. Thank you very much.
Cool. Just do some stocks, I think.
Go for a stock. I've got one to add after you've done yours, mate.
Right. I was going to mention Empiric Student Property, ESP, and the fact that it's got a huge, I hold ESP, right? It's got a huge discount, 15% to the NAV. Whereas when you look at Unite Group, UTG, that's got a premium to NAV of 17%. Now, I was going to talk about this a lot, but it got tipped in Investors Chronicle the other day. So they sort of stole my thunder a bit.
Reverse psychology going on there, Pete. They usually tip it, you talk about it, and now you want to talk about what they've tipped it.
It just drives you mad. So anyway.
The irony, mate. The irony.
So anyway, what I will say is I've started a new initiative on my TikTok account. I've actually opened I've got my @WheelieDealer TikTok account. I've opened a new one called @WheelieDealer2 TikTok account. That's going to be more about stocks, more about markets. You'll probably find it interesting. Certainly, if you follow my normal, my first TikTok account, you might as well follow that one as well. I've already put out 3 videos that are about stocks. I'm running through my own portfolio and giving very honest, very frank assessments of what I think of the stocks. And I've already said that several I wouldn't buy myself, even though I hold them, so go figure. But anyway, on there is one about ESP. So, you know, if you listen to that, you'll hear what I was going to probably say here. Anyway, the one I will talk about is a really interesting situation. And I've noticed today that the share price is still pretty low. You know, it's not really done much. This is Wood Group, WG dot. Now, what I find intriguing is I mean, there's a chart of Wood Group, right? I'm going to hold it up, Leah. You can see it's sort of gone down and it's basically been battered. It's been battered. What is interesting about it is it's got quite a lot of debt, right? But I was
going to say
they are selling off a business. I think it's a business consultancy chunk. And once that's sold off, and it's all going through, you know, the process, once that's sold off, they will pretty much have no debt. So that will transform the balance sheet and completely change this investment. Now, where it gets interesting is WG dot is very much involved in energy, as in oil and whatever. And WG has quite a good history. If you look back, say 10 years, whatever, it was doing quite well. But it sort of got into difficulties. And I think a lot of it, remember when the oil price tanked and basically they were paying you to take oil away. God, how different times are.
Absolutely.
Yeah. Now, obviously, things have changed. And like I say, I think with this being solved, the other thing that I really like about it, which keeps it interesting, is they've got a new CEO. And I always like that change of management when you've had a struggling business. So I think it's an interesting one. I'm not saying that anyone should buy it. It's certainly not a recommendation. I don't hold it myself. But I just think it could be an interesting stock for people to have a good look at, you know.
Cool.
What do you know of it? Do you have any?
Oh, I know it of old, Pete, and it used to be one of the go-to companies in a, oil services sector is what it used to be called.
Yeah,
But it's I think part of the issues they've had, and maybe it's mismanagement on their part,
usually
is
is.
that a lot of the contracts that they had historically, or a good percentage of the contracts they had historically, the margins were paper thin. And once they went wrong,
Yeah,
it was costing them to finish off the projects. So there's no profits in it for them. They were making a loss on finishing projects. And you can't sell a project. You can't pass it on to someone, another person, because you're making an even bigger loss.
yeah.
So all price tanks, the cost goes up. Their margins are paper thin. And they were making a loss on projects after project after projects. And that's where the debt kept building up.
Yeah.
So you can imagine why people go, oh, not again. You know what I mean? So like you say, the consultancy side of it getting sold off, becoming debt free, reinvigorating the balance sheet, get some people in that can actually, build together and put together a good contract, win a good contract with a good safety margin regarding the contracts, then you could do well. And right now, energy related companies, it's their time, isn't it again? So
Exactly.
good call.
I mean, it's
good one to research.
I mean, the other thing with it is like we say, it's a thing to research, but it's one of those where it may not be the right time to buy it now, or it might be a time to just put a little placeholder position to keep you interested in it. But further down the track, 6 months, a year down the track, we could see it, break out of that sideways range that it seems to be in now, start breaking out, start moving up, and you could catch it really well and add to your position or whatever. So it's an interesting situation I'll raise here.
Okay. Right, I've got one stock that's I wouldn't say it's off the radar, because it's been on the radar and it's been heavily touted for quite a few years now. And the share price has gone up, down, and now it's down. And today there's some interesting news regarding some technology that they've launched, and the share price has pinged 16%. And this is why I want to talk to you about it.
Wow.
So, Pete, if you stick in the ticker in your phone, right, GFIN, the name is
Gfinity.
Gfinity, right? And essentially, it's an esports and digital media company. So you look at all of these sports people, these guys and ladies are sponsoring, becoming ambassadors of, buying their own teams. Cool. So essentially, they're involved in that space, and it's a multi-billion-pound industry, which is what they're trying to tap into. But the market cap right now is tiny for Gfinity. They've got some big people involved in it, invested in it, and trying to generate some revenue from this company. Bizarrely, despite its size, because it's been at this for a few years now, it's not that far away from profitability, believe it or not. So I've looked at that today. I put an RNS, the positive RNSs about it today. Somebody sent me some additional information. Shout out here to Sean Dent, the guy who sent me this particular information. It's not a company I've looked at regarding investing, but I think it might be worthwhile researching in case they've actually reached an nadir and they're actually finally at that point where this stock could actually go further, consolidate, and make some money. This is not a tip or a recommendation. It's not something I'm looking to purchase myself, but it might be worth just investigating if you want to buy a small cap. That could go quite far if they can generate the revenue. They've been at this for a while now, looking to generate revenue and more revenue. Massive space. To always talk about TAM, total addressable market, huge space to get into. Who knows? Look up esports, and Gfinity's name's usually around there somewhere. So research it. That's last one I've got for the day.
Yeah. Well, mate, I mean, I don't know if you want to end it there. We've been talking for quite a while.
You've got anything else to add, Pete? Add it.
Obviously,
right. As I always say on this podcast, and horrible. I would have quite happily not done this podcast today. I got the news from Pete late last night, and it just took me sideways.
Yeah.
I'm not scared to admit it. One of my biggest, hardest things I deal with, that I struggle with dealing with, is grief and loss of people that I care about. And Steve was one of the good ones.
Definitely.
Right? You don't meet good, authentic, genuine, caring people often enough. And we've lost a good person, this week. And it fills me with dread when I get sort of news, Pete ringing me at 10:30 saying,
yeah, it didn't
ring
help
me
that
urgently. Oh, SHIT, something can't be right. I hope Pete's all right. And then he tells me the news, and I've not dealt with it yet, and I'm not going to be dealing with it for a little while. It's not something I can handle well. So I just beg you all to just do something, regarding the people you've got in your family that you've not seen for a little while. Pick up the phone, go and see them this weekend. Yeah, go and spend some time with some people. Just go for a walk, do something different with somebody you haven't done it with for a little while. Give some people a love, a hug, call. Yeah, and just cherish these people, your friends, your families, whilst you've got them. Yeah, take care, people, and thank you for your support. And just give your prayers out to Steve and his family, because they're going to need it right now. Okay.
Yeah,
hopefully the next podcast will have a guest on. Hopefully we'll be a bit more upbeat. So please forgive me for just being a bit, but it hit me hard. Okay. Take care. God bless. Pete, go.
Well, I just want to. I'll add to that. I won't talk about another start. I'll just say, it was a weird one for me, because I got the direct message from Steve's brother, and I read it. And first of all, I was very sort of matter of fact and just being practical and responding to it. And then, I sort of was trying to watch the telly, and it just started to sink in, and I was thinking about how much Steve had supported me, and it's like Peter just said, he's one of the good guys, and it's just typical of the way the world is, that, some of the unpleasant characters, like, the guy running Russia, without mentioning any names, it never seems to happen to them, but the good people go, and it's sobering, and it does make you think about things, so mate, let's leave it there.
Yeah. Ladies and gents, thank you ever so much for your support. I hope you enjoy this podcast. Please share it on Twitter and elsewhere on social media. There's something aspect of this that you like, give us a comment, give us some feedback. Anything you don't like, give us a comment, give us a feedback, and we'll add it to the write-up when we do it. But when this goes out on Friday, have a listen and just enjoy your weekend, and take care. And we look forward to speaking to you again in 2 weeks' time. Take care. God bless.
Thanks.
This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.